Hello again, traders. Doing job there from DRFX, Forex and Trading. Now, in today's video, I'm going to be taking a look at one of the many market traps that the market sets for us that can lead to trading losses if we are unaware of the relationship between the daily chart and the 4-hour chart. Once we are aware of what is taking place on the daily chart and the 4-hour chart, and we see that both time frames are in sync with each other, then we can avoid these types of situations that can lead to painful and unexpected trading losses. Now here we see the situation on the daily chart of the Australian US dollar a few days ago, where the market was clearly forming a range setup with a double top signal at this area here telling us that the market was going to continue this bearish movement and complete the formation of this range setup. So here we see that the support boundary had already been formed with these two support points, and that the market needed to provide us with a second resistance point to complement the one already formed here and complete the formation of the range setup. So these double top formations were the signal that were telling us that the market was going to be forming this fourth wave and therefore completing the formation of this second resistance point and the overall range setup. So the overall scenario was that the market was likely to continue this bearish movement in the next couple of days as the market heads towards the support boundary. So that is why, even though the 4-hour chart had given us a strong U-turn and a strong bullish signal, it was very unlikely that the market was going to rally in response to this signal, because it was in conflict with what was more likely to be the scenario on the daily chart. So the daily chart, which is the stronger time frame relative to the 4-hour chart, was dictating that the market was more likely to move bearish, whereas the 4-hour chart was telling us that it wanted to move bullish. So anytime you see a situation in which the 4-hour chart is in conflict with what is more likely to be the scenario on the daily chart, any signal that you see provided on this time frame has a very low chance of actually providing a profitable trading opportunity. So many persons would have been tempted to open up long positions following the close of this signal, but as I stated here, the market was unlikely to rally because of the bearish setup on the daily chart, so therefore opening up a long position here would have been risky. So this is why it is no surprise that after 24 hours, the market became volatile and pulled back instead of rallying in response to this bullish signal. Now, this is one of the reasons why I use a 24-hour time period as the maximum holding period for my trades. If a trade is going to be successful, then the market is going to respond to the signal given within 24 hours. If it is not, then if after 24 hours it has not responded to the signal, it is very unlikely that it is going to respond to that signal. So you can see that after the market gave us the signal, it has pulled back, clearly indicating that the move to respond to the signal would have been a risky one. Any trade opened up in response to the signal would have been a risky one, and many traders now would have been experiencing trading losses as a result of this trading decision. So this was a quick example, but a very important example of showing you why it is very important that the signals and the setups on the 4-hour chart need to be in sync with what is taking place on the daily chart. If the overall scenario of the daily chart is telling us that the market is going to be moving bearish, then any bullish signal that we see on the 4-hour chart has a very low probability of actually being successful. So that is why we need to pay attention, first of all, to what is taking place on the daily chart, identify the overall setup, identify the more likely market direction over the next couple of days, and then once we have established that and we see a signal on the 4-hour chart that is in sync with that market forecast for the daily chart, then we can trade setups and signals on this time frame that are in sync with that expected market direction. Otherwise, any trade and signal that is against that market scenario has a very low chance of actually being profitable. So let's avoid these situations by becoming familiar with the setups and signals on the daily chart and the 4-hour chart, knowing when they're in sync with each other and knowing when they are in contradiction with each other, so that we can avoid these types of market traps that tend to lead to trading losses on a daily basis and on a weekly basis.